the session what we have is credit risk management on your diploma in credit management. So we'll start the session. I will show the slides what you're going to do. In the meantime, you may unmute your mic and ask any questions on the way. I will stop and answer. Or at the end of this, you can write down in a small piece of paper, and we'll give you a time, and one by one, if you unmute your mic and ask, then we can clarify the doubts what you have during the session. So to start with, this subject, credit risk management in the credit management diploma is an important one, because this covers your, we will do a kind of a, we looked into the areas what you have already covered, and we'll see the risk involved in your customers as well as risk to the bank. That you must understand credit risk management. First, we try to define credit. Of course, I don't have defined. You have already gone through this. Credit is you give money away to a customer, expecting him to pay back with interest on the required date or given time. That's how we extend our loan facilities. We give facilities to customers. So credit, we call it a bread and butter of banking, because when we accept deposits from, we say main banking function is you accept deposits from economic agents. We say, we put it in a very technical form. Economic agents means your customers who has surplus money, and they don't want to invest by themselves and take the risk. So they thought best way is to deposit this money in the bank. And we go as a business entity where we accept money from economic agents who have surplus, and if we pay them a particular interest what we have agreed, but to cover our cost and to make profit to the institution we work, we need to give away this money by way of loans and advances, and that is what we call credit. Now I'll go into risk. The next word is risk. Risk is also a very common word. You think people apply this word for various things. In banking, risk is you make an investment expecting a return, and if you are not getting that return, is called risk. So what we do in our credit is we are making investment. Actually, we place our money with customers who we identify as a credit. They have, we call them, they are credit worthy. So we make investment of all our loans and advances among credit worthy clients, and we want a return from them. That is, we want the capital and the interest, agreed interest on a particular date. So if we are not getting either the interest or the capital, we call it we are running at risk. So credit, to go on the risk subject, I will give you another explanation. But in the meantime, we go into management. Management, I think, management is, organizing, getting the resources, and then organizing them in that we'll have an output which have more value than what we have input. So kind of management is organizing, planning, making very efficient way of process, so that we tend to enhance our value. So that's what you call these three words stand for. But we'll see what we can get from definition of risk. This is how it is being explained by the risk professionals. They say unexpected variability of asset prices or earnings. Now say I will go into the subject matter of asset. Asset is a part of your balance sheet. That means you have assets and liabilities. Now, one of the banking asset is the loans and advances goes as a current asset of the bank. That means if we list all the money what we have given to customers by way of loans and advances, we'll apply to the asset side of the bank. And if any customer doesn't pay, and if we have to write off a debt, write off a facility, we say the asset is not realizing the original value. So unexpected variability of asset prices means you expect certain amount of earnings out of interest and also capital to come back. If that doesn't come back, we call it a risk. Exposure to uncertainty. Now say you can have a loan outstanding, but this customer has not paid for, we'll say, 6 months. And we apply certain rules in the bank. If a customer is not paid, you have to categorize them as non-performing, and then we may have to stop applying accrued interest into our revenue, what we call it interest suspension. Then if we think we are not being able to recover this money, the capital, we also make provisions. So exposure to uncertainty is that we are in credit sense. You can have exposure to uncertainty in various other aspects in banking also. You can place your money on shares and any other investment. And if the prices of those come down, is also is exposure to uncertainty. Possibility of loss or injury. Now, risk we apply in terms of financial instrument on the first two, that is in unexpected variability of assets, and then also we call it about exposure to uncertainty. We also go into another area in banking, we call it operational risk. Operational risk could happen by way of a loss or injury. So in order to describe the operational risk aspect, we also include this definition. Possibly loss or injuries means if you get a customer coming into your banking lobby, and in case your janitor may have, apply some water to clean the lobby, and if a customer slip and fall, and he could even go to courts and make a claim. And when you make a claim, and if bank has to pay, bank will suffer a loss. And that loss, we call it a operational risk. So definition of risk can apply to your earnings, your investments, your assets, or to your operational aspects in day-to-day banking. So we go into the next slide, which is a very important slide. We are going to look at, because nowadays one of the buzzwords in banking is risk management. So to look at risk management, we should know the type of risk an institution face. Now, we have only a very small portion under the credit management to cover, that is only the credit risk. But banking nowadays they call it a risk machine, because we face enormous amount of risk in different types. So it's better to know the types. Now on the screen you can see I have put 3 cycles. These circles interconnect in each other, and in the middle I have put a hub. That hub I have put it in yellow. So these 3 cycles are the 3 major risks the bank, generally a financial institution, face. That is strategic risk, financial risk, and operational risk. Now, banking is a financial institution. Now, major risks come from management of financial aspects in banking. So, this financial risk also further classified into 3 major areas. We call it credit, market, and liquidity. one of the main areas to manage financial risk in a banking institution is to manage the credit risk, manage the market risk, and manage the liquidity risk. So we have in our syllabus for credit management diploma, we only cover financial risk relating to credit risk. Brief, important any loans what you make can make an exposure, and those exposures if are not coming, that means your capital and interest is not coming, you will face credit risk. Market risk is you also make investments. You can make in treasury bills, treasury bonds, stocks and shares, any other financial instrument. So if the value of that instrument falls below your original investment, you will get into a market risk position. Banks also need to be very mindful about another risk factor, which is we call liquidity risk. We accept deposits from customers, and some deposits are short term, some are long term, some are payable on demand. Now, any money what is in your savings account or current account, customer could walk into the bank or to the nearest ATM should be able to withdraw. And to do that, we need to have sufficient liquidity. That means we need to keep certain amount of money what we collect from customers as deposits in cash or near cash item, where quickly we should be able to convert that investment into cash. So if you don't maintain sufficient liquidity or the cash, uh, you can expect a run on the bank quickly. Run on the bank. What I mean is, we run our business mainly on confidence. In case if you fail to oblige a customer with his cash demand, he comes to withdraw his money, and if bank is unable to meet that obligation, the news of that non-payment will spread very fast. And we say if confidence is lost, that lost confidence will travel very fast among rest of the customers, and then everybody will run onto the bank to collect their money. This has happened in the past to some of our banks, and it's a very critical situation if you don't maintain liquidity to oblige financial obligations what you owe to your customers. So financial risk is the major risk a financial institution run. In that, we call it credit, market, and liquidity. Now, if you can see me, I want you to do a small exercise. This exercise is to draw up a balance sheet of a bank. Now, you can take a piece of paper and balance sheet of a bank. I want to draw a equation which will represent the balance sheet of a financial institution. Now, I will help you, but you can just write, because since we are doing online, I can't go to a board. Today I'm doing it from home. And generally, when we had this situation, I used to focus on a whiteboard right behind in the room where we used to do our presentation at the Institute of Bankers. Uh, Today I'm doing it from home, and I didn't keep a whiteboard right behind me. And as a result, I want you to take a piece of paper and join with me in creating a balance sheet of a bank. And generally, a balance sheet of a bank should consist of current assets and fixed assets on the asset side. So you can write current assets. I will give you a small abbreviation to that. You put CA plus fixed assets. We call it FA. So this is your total assets, your current assets plus fixed assets are your total assets. So the equation CA plus FA equals your total liabilities. Now on the liability side, when we accept customer deposits, it's the major liability, and that goes into current liability. So on your liability side, the first item what we have is CL, that is current liability. Current liability represents customer deposits. Banks also accept long-term liabilities by way of like debentures or various other financial instruments which we issue to get money for us on a long-term basis. We call it long-term liabilities. Now, long-term liabilities, I will give an abbreviation. You can put LL. So, on your liability side, on the asset side, we put CA plus FA, which will consist of total assets. Total assets should equal total liabilities, that's the balance sheet. So the liabilities will include current liabilities plus long-term liabilities plus we have to put the shareholders' money also, because shareholders also have put money, we call it, and also in the past years also we put it. So all this will total up to, we'll say, equity. So our equation goes like this: CA plus FA equals CL plus LL plus E. E stands for equity. Now, this is our equation. Now, in this equation, I would like to give a little bit of value to this. We'll call this balance sheet. This particular bank has a total assets of, we'll say, 100 billion. Now, so your CA plus your FA, that is total assets, has a value of 100 billion. And we say it is equal to your total liabilities. So therefore, on the other side also you have to represent 100. That is your CL plus LL plus E also equals to 100 billion. Now I am going a little further. I am going to identify what kind of values under each item we could segregate out of this 100 billion. Now, in a bank, we generally accept deposits. So, I'm going to the liability side. Out of this 100 billion, I'm sure we leave on customer deposit. So, I apply 85 billion to CL. That is your current liabilities. The value is 85. We also can accept debentures. I put a number 5 billion to that, and then the balance, that is 100 minus 5 and 85 works out to 10. So your equity is 10 billion. So we have constructed the liability side. We coming into asset side. We have current assets and fixed assets. Generally, bank is not a manufacturing unit. Bank is a financial institution. We don't have huge plants. We have buildings, but sometimes even those buildings are rented. So our fixed assets we try to keep minimum as possible, because these fixed assets are not generating income. Because financial institution is our main activities, we call it financial mediation. So we have to make full value of money what shareholders given, our customers have given. Therefore, any money coming from long-term liabilities, all what you would like to do is either invest or grant credit facilities, so we could earn more money. So generally in a bank, we have a very large current assets. I will put in a normal circumstances about, out of this 100 billion, 90 billion into current assets, and 10 billion fixed assets. We'll go a little further on this balance sheet. Finally, I think you will have a paper which I will show what I have constructed after I complete this exercise. We also like to go a little deeper into current assets. What will consist of bank's current assets? Bank's current assets, the largest item, I will come last. The first item is I told you about liquidity. We are an institution which is being supervised and overlooked by our regulator. Regulator is Central Bank of Sri Lanka. So they also have various regulations on how we manage our risk. So generally they say you need to have at least 7% of your total assets in cash. This cash can be in your wallet, it can be in your main, your teller machine or in your counters or with the central bank current account, which they will not pay any interest on that. So this money can be immediately used to make our financial obligations to our clients. So this money, what is in your wallet, in your counters, in your teller machines, and in transito and in current account of central bank says at least they would like banks to maintain about 7% of your total assets in cash form. So we also call this cash reserve, and so we put 7 billion onto cash. Then also there's another requirement, banks are supposed to maintain 21% of their total assets in liquidity assets. Liquid assets. Liquid assets means which can be converted back to cash quickly. So to make 21%, now we have cash 7. So at least we must have investment minimum of 14 in liquid assets. Treasury bills, treasury bonds, or stocks and shares, which we can have a marketable. You can go to stock exchange and immediately sell. That kind of liquid assets we can categorize as our investments. So the second item, first item is cash. Second item on your current assets, we put as investment. So investment, as per regulator, we need to have total liquid assets of 21%. So I will keep in the minimum, I will apply 14 here. So 7 plus 14 will make 21. So we have allocated 21 out of our 90 billion current assets to keep money in cash or in near cash form where you can turn back into cash quickly, but we have put them on investment to make earnings out of that. So out of 90 billion, 21 billion has gone to cash and investment. The balance will represent your loans and advances to customers. Those are the items which I want to specifically say. Any questions? I want to specifically say out of 100, at least 69 billion out of 100 billion balance sheet, 69 billion is now with the customers because you have given us loans and advances. And when the money is with the customers, what is that? We have given credit. So you have a 100 billion balance sheet, 69 you are exposed to credit. That 69% will represent your credit portfolio, which is generally, since the money is with customers, we have given them with the hope of getting interest and the capital back on a particular given period. And if it is not forthcoming, we call it, we run the credit risk. So you identify now the balance sheet, I will explain to you in terms of balance sheet, the largest risk for a bank, because 69% of 100 billion will represent credit, and as a result, largest item in your balance sheet is credit, and therefore credit risk is the major risk for bank. That's why it is important to study credit risk under your credit management diploma. So today we are going to learn credit risk management in depth, so that we will cover the largest balance sheet item on our banking. So
So
in
excuse
order to
me.
give a little bit about the rest of the risk, now we covered financial risk. We also have one circle, we have strategic risk. අපි යනවා balance sheet එක අපි construct කරමු balance sheet එකට. ඒක පෙනෙන ඉස්සෙල්ලා I will talk about the rest of the risk in our risk type. Strategic risk is also important to a bank, because strategy, you understand what is strategy is upaya marga. If you want to, we are in a very competitive business. Now in Sri Lanka we have I think 26 banks, some 50 odd other financial institutions in the non-banking sector. All are competing for us. Under Sri Lankan economy, it's a comparative to the world standard, we have a very small economy. So in this economy, if we have to compete, you all can hear me, no? There was a small technical error, something came up on the screen. Strategy means our long-term actions we take to achieve our objectives. So strategic actions is related to our customers and to our competitors. So if you don't compete with our competitors, we will lose our market share. On the customer side, we need to please them and offer them the best of services, new products, various other conveniences with customer demand, if you really need to be in the business. So strategic banks have a marketing department who create a strategy for the bank, create new products, and we do advertising and do various marketing related activities in order to be strategically important for us to be in the business. So strategic risk is very important, especially financial institutions, because of the competition. Now, however, we are governed by, I told you earlier, also governed by the regulator. Regulator is central bank. Central bank doesn't allow undermine or undercut another financial institution by way of offering lowest interest rate. So they have regulated this particular industry, especially financial services industry, so that we don't do unethical things. We always follow the regulators' guidelines. So strategic risk is related to, I told you about customers and competitors. So we do various things to be in the business and over a long period. Uh, so on the other hand, on the middle, I have shown this in yellow. We call it regulatory risk, and we also attach very important to this area. We call also compliance risk, because we are being guided and directed by Central Bank of Sri Lanka, and we need to follow their rules and regulations, directions issued time to time. All that we need to follow. So if you don't follow, we will subject to compliance risk and various penalties, and even might even lose our license over a period if you are not compliant. Then the other circle is related to operational risk. Operational risk is generally described as risk related to people, systems, and events. So people is either can be outside people or inside people. That means it can be employees or general public. I take a risk of employee doing a fraud will end up in operational risk, because if a fraud is there and if bank has to suffer a loss, we call it operational risk. If someone rob your bank from outside while you are transporting cash or whatever, it's a public robbery, and so it also involves people. And that factor is an event, and we also run a loss. We have a lot of systems. We have computers. Now it's very important under current situation. All the banks are almost open 24 hours, because we allow them internet banking, we allow them digital banking, we allow online operations. As a result, if anyone get into a system, hack the system, or break firewalls in the your computer systems and get into our systems, can play havoc and make huge losses to the bank. They could transfer money from one account to the other. Those things will get into a loss situation, and that losses also call it operational losses due to systems. Then the events can be internal or external. I explained to you, fraud is an internal event. External event can be a robbery. There could be other areas like fire, theft, and various other things. Could fire, theft, flooding, even tsunami are external events that could result in loss to a bank, and those losses also categorized as operational risk. So in between, I have put some arrows for those interconnections. Now, say financial risk coupled with strategic risk is related to reputational risk. If you don't treat our customers, doesn't provide conveniences, or meet the obligations on time due to liquidity, we will run the reputational risk. Actually, banking runs on reputation and the confidence of the client. So if you lose that, if you lose reputation, reputational risk can, play a major role in losing a lot of business. So it's another very important area. We run strategic risk and operational risk. In between, there's another circle, interconnect. I have put as a legal risk. Most of our transactions, we do it on a contract. Either suppliers will provide certain things, customers sign fixed deposits, there are agreements, forward agreements, all those mortgages, all are legal contracts. And if we fail to perform our part on a legal contract, we run into legal risk. Even your employment contract with your bank is a contract. And if the employer doesn't pay you the agreed amount, you have the right to take legal action against your institution. If they have been penalized and not Those are called legal risk to financial institution. Then also I told you that now we operate on different platforms. Those days, banking business is generally we call it brick and mortar operations. You may wonder what it is. Brick means the bricks to make things what you take it to build houses. Mortar is cement. So you add cement to bricks and you make walls and make buildings. So brick and mortar means there's a building. Building means there's a branch. So mostly those days the operations take place only in branches or in your head office, which is also brick and mortar unit. So anything happens, it has to be happen in such a business premises. But now it is not that. Now we have different delivery channels. That means we have um, internet banking, we have phone banking, we have ATMs. So they are not in the premises. They are virtually available for customers or in a different locations. And as a result, those platforms has to be run on IT, uh, using IT and IT technology. So if any of your systems fail, and as a result, if you have to suffer a loss, that is operational loss, but we can categorize them as a technological risk. So banking, I told you, it's a kind of risk machine. So while having idea of all the other type of risk, now we are going to focus on one type, which is credit risk. Now, uh, if you can see me, first of all, I want to show you the balance sheet which I constructed. Uh, can you all see this? Can somebody unmute the mic?
Lift it a little bit up.
How is that? We can't see the whole paper, sir. Uh-huh. Uh, how is now?
Hold it little bit up, sir.
Uh-huh. So I will read this again. What I have done was
Yes.
current assets. Under current assets, I have put cash. I have put investments. I have the values are cash 7, investment 14, and loans and advances 69 work out to 90. So our current assets value is 90 billion. Then I have put fixed assets as 10. Then that works out to total assets of 100 billion. On the other side, I have put current liabilities, which is customer deposits, which I have put the value as 85. Then I have put long-term liabilities. I have put 5. Those are debentures. Then I have put 10 for equity. Equity is shareholder funds. So this is how a balance sheet of a bank looks. Hope I think you all also have made something like this. So what is the relevant in this? I want to emphasize that importance of out of your balance sheet, 69% represent credit, and therefore managing the credit is very important. So we'll go into what is credit risk is. So if you have to give a definition to credit risk, I will put this definition. It's a potential for financial loss where customer or counterparty. Now remember certain terms what we use in risk management is we always say the party who is dealing with us is a counterparty. That is our customer. If a customer fails to meet their financial obligations, now say if a customer failing to meet financial obligation means he is defaulting the bank. So if a customer defaults to pay either capital or interest on an agreed period, we call it a credit risk. So remember three important things: capital, the interest amount, and the period. Now say if a customer takes a loan for 3 years at the rate of 15%, and if he pays on time this, during the period, we'll say 2 years he agreed, we call that it's a risk-free credit facility. Anything other than that involve credit risk. If a customer takes a 100,000 to pay in 1 year, and if he will pay the interest and the capital in 15 months, still we have a credit risk, because the next 3 months, that money we cannot allocate to this customer, because we were expecting, I told you, risk is obligations or the expectations not being materialized. So if our expectation is to receive the money with interest in 12 months, and if we are getting it in 15 months, still we run the risk of credit risk. So it's important for you to understand. Now we do this rescheduling of loans, and then when you reschedule, sometimes you give a discount on the original interest what you have charged. That means that facility has a credit risk, because we expected to recover that money in a particular period on an agreed interest rate, and now we have failed. So if you have failed, means we have run into credit risk. So customers default either by way of capital, interest, or period will amount to credit risk, and we call this counterparty risk. And we also can give in another definition, when what happens is when a customer default, we will create a non-performing asset in our balance sheet. So if a customer fails to pay money for 3 or more months, we categorize that facility as a NPA facility, non-performing facility. When a non-performing facility occurs, what happens is you either will lose interest or you lose capital. So significant amount of assets become worthless. That means in your balance sheet, part of your loans and advances become NPA due to customer not willing to pay or unable to pay, is also amounting to credit risk. So major thing what you need to understand is, when we give money to customers, we expect that money to come, the whole capital, amount of interest we agree during the period we agree. Otherwise, bank is subject to credit risk. So when we give a facility, that's why we are really particular to do the creditworthiness of the customer to avoid credit risk. I go to a very important slide which I created. The slide which I created earlier for categorizing types of risks. In that we have explained all the type of risks what a bank encounters. That slide was very important. I think you to understand. I spent little more time on that. I'm going to spend little more time on this slide also, because you need to understand the process, how we give credit and how do we manage credit. So there are 2 parts in our process. The first part is we call it credit management. Now, if you are in the business unit, if you are working for credit department, and we call it credit department to grant facilities and evaluate customers, provide credit facilities, is your credit management business unit. But in a bank, we also have a risk management unit. In that risk management unit is the back office. They don't deal with customers. They might deal with you if you are in the business unit. It's a closed circuit or back office. In that risk management unit, they have another small section called credit risk management unit. They also do kind of managing credit. So the first risk management part of credit will be undertaken by the business unit. You need to understand, even if you are in the business unit to promote business, you cannot ad hoc give facilities and put the bank into a credit risk position. So that's why so many regulations, you have laid down procedures in the bank to give facilities. There are specified securities to be taken, and a system to follow. All that is there in the credit management unit, because you also manage the risk of non-payment by customers. So we'll take the business unit first. You can see on the screen, I start on the my right side, probably your right side also, or probably your left side. You have the most important item in the bank is customer. Now we have customer who is coming into the bank. I have put an arrow and shown to a unit, that is credit department, where credit origination take place. Now you see, customer those days will walk into the bank and come to the credit department. I think that in concept comes over there, you have a little knowledge about him. Um, Probably you can run a credit report, you can call for status report, yet you don't have much knowledge about this client. For you to actually evaluate his facility, thereafter you have to peruse a lot of documents, make certain visits, and also uh, do a thorough check, and generally demand securities in order to avoid credit risk. Nowadays, that's why it's important we have in banking, we have business promotion officers who even promote loans. We have customer relationship managers who will get in touch. We have new business, we have sales forces who will visit customers who are at the moment non-customers, but then they will identify um, those customers who are, in business, um, they are worthy of, receiving credit. They can bring them into your bank and to propose facilities what they want. We call this business development. So this method is important because nowadays customers have so many shops to shop around, so many banks for them to go. If one bank says no, they can go to. So banks also, strategically, we also need to, get the best customers. We call this process generally cherry picking. You don't need each and every client who are either credit worthy or non-credit worthy to come in and waste your time. So best thing is, let your sales force do a preliminary study of a client and forward a business call report to you. So then when customer is there, if you have a business call report of him, it's very easy to originate his credit facility. So that's, we call it business development. In this process, either customer can directly come to you for credit facility, or your business unit could bring a customer to you. On the credit origination, it's very important for you to get all the information about this customer in order to evaluate his proposal. So origination is a frontline position where you need to get all the information, including the documents what you require to process this facility. So I will take an example. Now see, if a customer wants a housing loan for the housing loan, I come to you, and at the credit origination unit, you give me a form. In that form, I will see what I need to submit, and you need to insist this customer that all those documents required for him to originate the facility. It could be letter from employer certifying your earnings, if you are a business person, last 3 years balance sheet, bank if you are banking somewhere else, last 6 months, your banking sheets or your custom sheets issued by the bank. Then relating to security, you will ask all those. You need the copy of the deed, you need the copy of plan, approved plan, then EOC, various approvals from town council. All those are generally listed in your housing loan application. So you need to see that you collect all those required documents. If it's a corporate facility, you need to get 3 years audited statements. You may need to get a company profile, their product profiles. You need to get their stock turnover, the stock statements, debtor statements, various financial documents, and also if you are taking a security, all the related documents related to security also you need to be taken at this level. So credit origination is a very important function if you are to avoid credit risk, because if you accept deficient uh, documentation to evaluate this customer, you are not doing the right evaluation. As a result, this customer's evaluation, the creditworthiness cannot be assessed properly, and as a result, if he defaults, bank will run into credit risk. So we go into the next item on this credit management process, which is called credit evaluation. They say most of the facilities go bad due to bad credit evaluation. A lot of people tend to agree on that, because if you are biased in evaluation, if you are not carried out credit evaluation proper, there is always chance that customer default could occur. So credit evaluation, we into two areas. You can do financial analysis and a qualitative analysis. In this financial analysis include something to do with figures. I told you, if it is a housing loan, you ask for customers' income. He will present his net salary uh, or salary sheet. From that, you will identify how much money you getting. Then what you do is, in your application, you will ask these other financial obligations, including amount of money for his living, and you deduct all that. Then you will arrive as a surplus, and those surplus should be sufficient to pay the installment. So that's how you analyze it in very simple way, individual client. But when you come to corporate credit, the financial analysis is much more tedious and different. And because you have to get last 3 years balance sheet, you analyze all the ratios. You have to analyze customers' profitability, customers' efficiency, all that will be analyzed using these financial statements and applying various methodologies to arrive at whether the customer is creditworthy or whether he has surplus money to pay the installment if we borrow money from you. Apart from that, there are other analysis we call qualitative. Qualitative means that cannot be, given in numbers, because those are also important. You get a client whose name appear in crib, that means he's a defaulter. You wouldn't like to give credit facility. That to identify his past track record is a qualitative analysis. So we run the crib report. Crib report will give figures if he has borrowed money, or crib report says okay, that means he has borrowed money, has paid all those installments, is his indication of his track record. So that is a qualitative analysis. To take a company, there are a lot of other things you need to analyze. You need to analyze their product range, and you need to analyze to see whether those products has a market to it. And in case anything happens to whether they have good suppliers to produce those products, and in case if there's embargo on those suppliers, what these customers will do, whether they have the alternative items, way of carrying on business, all those will be done. Also, if it is a corporate client, you also run a report of all the directors, so that you will know the reputation of directors in order to give this facility. So what we will do here in the credit management on the business unit, customer walk in, you originate the facility, you give it to a credit analyst or a credit officer who is capable of carrying out a credit evaluation. He will do a financial analysis, he will do a qualitative analysis, then he prepare a paper. Taking into all this account, that paper is for your credit approval paper. We call this credit appraisal form. And when this paper, he will recommend the facilities what these customers have asked or decline the facilities in case of risk. In case of risk, he also can recommend subject to taking securities. So this paper will carry customers' financial analysis, customers' qualitative analysis, um, all this in details, including certain ratios, what he has done to show his creditworthiness and repayment capacity. Then also certain risk you will point out in this paper, risk of not being able to pay, and to cover those risks, you also will propose certain amount of risk, certain amount of securities what you propose, and then you will do a description of those securities, and you will complete the paper, and you will sign. You'll say you are recommending the paper subject to all what you have written on this credit appraisal form. Before 2007, before this risk management operations included, this paper will get approved from your business unit itself, and then facilities will be disbursed. Now, our regulator, central bank, has intervened. At least large facilities, this paper needs dual approval. But what I mean is dual approval means this paper needs to be referred to another unit which has no direct contact with the client. We call it a risk management unit. And in the risk management unit, there is a sub-unit called credit risk management. So in this process now, we have covered the credit management, after evaluation. On that evaluation, you pass the credit appraisal form, what you have received, a copy of that to credit risk assessment unit. They will look at various other than what you look for. They all look how you have looked at the financial analysis, how you have looked at the qualitative analysis. They will also go through all that. Plus, there are a few other things which they want to focus on that. On top of that, what I put it on this assessment is a credit portfolio analysis. Now, say your facility will say pertaining to a client who wants to build a new tourist hotel, and immediately when this paper goes to your credit assessment department or the credit risk management unit, they will apply this particular amount of money what you are going to give into a portfolio. Portfolio is a categorized or industry section. They will put this proposal under tourism because hotels are made in that sector or the leisure sector or the tourism. So they will see the risk involved in that particular industry sector. Nowadays, because of the COVID, hotels are running at loss. And if you put a proposal at this level, credit risk department definitely will say this proposal has a very high risk due to the industry what they are in and the portfolio which belongs to. So these portfolios also have limits. say in a bank, central bank has given, I will go in when we are going further in our presentations, we will categorize them. Various industry sectors. We have manufacturing, we have trade, we have agriculture, we have tourism, we have transport, various sectors, about 11 sectors what the central bank has identified. They have asked you, put your portfolios into, when you give a facility, you classify your facilities into those portfolios and see the percentage of out of total facilities. And this also get referred to your board, and board of directors with the recommendation of the bank of the credit risk management unit, they will set limits for these portfolios. So now we'll say if you have 169 billion only your facilities, if your board says only 5 billion can be given for tourism, and if your facility new proposal what you send there will exceed that 5 billion, definitely risk management will send you the paper back saying our limit for this type of portfolio is being exceeded and risks are high, therefore they are unable to recommend it. So you will get credit portfolio analysis. Then I go into another area called credit capital. Now credit capital, now I want you to go back to my balance sheet. Hopefully you also have created that balance sheet, and under liability sector you have an item called equity. You also have heard this word, capital adequacy the bank. That means adequacy is whether we have enough. Capital means the equity what we hold in. So central bank is also have put certain regulations. Banks also should maintain 14% to the value of 14% capital to a percentage of all your risk-weighted assets. Now, I'm not going to do those calculations right now. So that is what you call capital. And this risk-weighted assets can be mainly from credit, because I told you in your asset side, 69% 3% credit. So generally, if your credit assets, the riskiness also being evaluated on those assets, and we weight them as risk-weighted assets. So we'll see when you send a proposal, we'll say you send another proposal worth 500 million, and if this 500 million has 100% risk weight, bank need to provide at least we say 10% of 14% of 500 million has to have in your equity. So that is what you call credit capital. Now these are evaluated based on the risk weight. Now risk weight is done through a mechanism called we are giving a rating of facilities. Now they do the rating of banks. You have heard of this name, Fitch. Fitch is a rating agency. They will evaluate the bank's position, the bank's strengths and weaknesses, and give a rating. These ratings can be either starting from AAA, AA, A, then triple B, double B, single B, and C. C is we also call it a non-investment category that generally so similarly you can evaluate your customers into these credit ratings. Nowadays all the banks have internal rating system. So when you give a credit facility, you put this customer's data into this internal credit rating module and then arrive at a rating. If customer's rating is AAA, We call it the risk weight on a triple A customer is 20%. But if a customer's risk weight is triple B, he will carry a risk weight of 100%. So always better to give facilities to customers who have a good rating, so you don't have to provide much capital from your equity for this particular credit facility. That is what you call credit capital. This requires certain amount of calculation, and that calculation will be done at the credit risk management department. And third item what they looked at is adherence to policy, procedure and lending guidelines. Most of the banks in document called now this can be two documents. Policy will have procedures separately. Now all your facilities, you need to follow the policy of the bank. If the bank's policy is to give credit to different type of customers, you should actually really market on that type. If banks, the procedures need to follow is that you need to, do a business call, you need to have all the documents in order, you need to execute all the securities prior to releasing your funds. You need to mention that all that in your appraisal form. That way, your credit risk management division will understand you have followed the procedure laid down by the bank, and you follow the policy. And some of the banks go into further extension of this. They have issued lending guidelines to different industries, how you should evaluate different type of customers, what type of securities you should obtain from those customers. Those are listed in your lending guide. Another document, important document, should be available at the risk management unit as well as on the credit management business unit, so that when you prepare appraisal form, you follow whether you have all your appraisal form is in adherence to policy, procedure and lending guidelines. If those things are in order, and if your financial analysis is in order, your qualitative analysis is in order, credit risk management also will give independent approval. So when business unit gives approval, the facility will go through. Thereafter, what you need is to execute the securities and run the facility. Now, granting of that facility doesn't end. Business unit will review these facilities at least once a year, and credit department, credit risk department will do a credit risk review. At least 35% of total facilities granted by the bank in every year, so that monitoring will be taken care of. So this is what is the credit process. Actually, these are two sides of coin. So you get heads and tails in a coin. So credit management, I call it a head. They need to manage the risk at this level because they are the people who are in touch with the customers. They have the first-hand knowledge. They need to do a proper in the appraisal form need to be verified, and they disclose all the risk involved with the customer as well as the strength of this customer in this appraisal form in order for credit risk management also to give a joint approval. So if these two processes do well, I think we have done our credit risk management proper. So it's very important for you to understand this slide. Understand the two sides of the coin. Both are managing credit risk. So if you understand the process well, managing credit risk is very easy, because if you follow the process and the system, there will be less default. And when there's less default, you will have less credit risk. So I'm moving on to now Credit risk management, the type of credit risk management we have two types. Credit risk can arise from counterparty risk. That means I told you counterparty risk is if a customer defaults the bank, either capital, interest or non-payment in time, we call this counterparty risk. So counterparty risk can be avoided mainly by, we call it look before you leap. We say you do a proper credit evaluation. I also have put here make good credit decisions. So when you do a proper evaluation only, you can take a good decision. You need to understand customer's business. That means to understand the customer's business, sometimes it's difficult for you to do it from your office. You may need to do a customer visit, see, obtain all the information about the business, how he does these things, and apply to bank's credit policy and methods, and to see whether this customer is creditworthy. So sometimes you may have to use your experience and judgment to make a good decisions. So counterparty risk is very important for you to manage in order to manage the credit risk. Then I also have put under be attractive to most customers. You need to have speed, right channel, and risk-based pricing. We will discuss them at a later stage. So second item on the credit risk, second type, we call it a concentration risk. I told you on the credit risk, the first item on the left side of that is called portfolio management, or we call it portfolio analysis. Now, say if you are a bank, you had given all your facilities to a single sector. We'll say your branch. I will take example. We'll say your branch is in Ikkadu. All your customers nearby in your bank are hotel owners, or either they will engage in tourism. Their shops are catered for tourism. Now, what happened in the situation of today? So you have concentrated only on one particular industry, and your credit portfolio include all the facilities what you have given mainly to one particular industry. Now, you didn't foresee a situation of COVID-19. You didn't foresee a situation where tourist arrivals will be minimum. And at that point, it was a very lucrative business. You didn't look at the risk. If something happens of this nature, that what could happen to your portfolio. So you gave all your facilities to tourism-related businesses. But what you have done is you have concentrated all your efforts, all your credit into one particular industry segment, and very unforeseen things happen to various industries, and as a result, now your tourism is at the very low ebb of in business. Most of the places are closed. Even they can't cater for local tourists. They can't cater for foreign tourists because of the COVID-19. And as a result, your credit facilities, what you have given to these clients, are not being repaid. They are asking for reschedulement. They are asking for interest reductions. They want you to write off certain things. All those will amount to credit risk. That risk we call it concentration risk. So in other words, we say, do not put all eggs in one basket, because if you trample the basket, all the eggs will break, and that has what happened to our tourism now. So somebody has trampled the eggs, the basket, and everything is broken. As a result, we have run the risk. So we need to establish sector limits. We need to diversify our portfolios. Manage portfolio by transferring high risk heavy on you. I will tell you what is a risk management tool. So credit risk management has two components. You need to primarily understand it has a counterparty risk, which is called default risk. Default risk is mainly non-payment of capital, interest on time. Concentration is you take facilities on a one particular industry or one segment, and if something happens to that sector, taking facilities to one sector is concentration. Due to concentration, if something happens to that sector and non-payment of those facilities are called concentration risk, and concentration risk also could create huge credit risk to your bank. Now we know the type of risk bank face. We know the credit process, which has two sides of coins. Then we identify two types of credit risk. One is counterparty risk, the other one is a concentration risk. Now we see, now I am looking at the credit management side. I am looking today only the business side, or I am looking at in the credit process, the customer comes, loan originations, evaluation and all that up to default. So we are looking on the business side. Now credit risk occurs when the customer defaults, and we call it a counterparty risk. Now we need to see why customer default. We have some customers whose incomes will get wiped off due to various reasons. So if you are employed, you get unemployed, you are unable to pay a facility. You also get type of customers. They have money, but their gut feeling is somehow to default the bank. They think one day bank will write off their default. So those guys are also called willful defaults. That's why we need to go into the character of a client. Important to identify character and the past track record is important to identify whether they have been willfully default in the past. Then we also have another reason for default is rising interest rates and cost of living. You need to live in order to pay. So if you will attach priority for your food and other safety measures, and during high interest rates, you are unable to pay your loan commitment. That also will counter. Have to say that those will amount to credit risk. Set price volatility. If you are given money for share trading, and if the shares prices come down, customer will make losses. As a result, he is unable to pay. Those also will be credit risk, counterparty risk. Lots of assets without insurance. You give a facility to a customer to buy something, he doesn't insure, fire or theft occur, he is unable to recover money from anybody, and as a result, he is unable to pay. Those are called losses of the credit risk. On the business side, customers, he can't sell his product and his sales will come down. When the sales come down, his profitability will come down. As a result, he is unable to pay. Sales could come down to competition, change of prices or regulations. Now you see a lot of, we'll say motor vehicle dealers. New regulation is government has banned imports of new motor vehicles. As a result, they have lost that particular business. As a result, now they are unable to service their loans. So businesses could make losses due to poor sales, new competition, changes in prices and regulation. As a result, they end up non-payment of their financial commitments or the loans taken. Then we run the risk of credit risk. It could happen to technology, employees and defaults could occur to lots of key customers, suppliers, mismanagement of costs, These are all business related things. If we say you have a garment factory, they have one customer in UK who used to buy your material or the clothing, and that customer will run into a loss in UK, and he suddenly cancel all the orders what has been placed on you, and as a result what happened, you lost your key customer. Until you find new customers, you are unable to produce and sell your stuff. During that time you are unable to pay your loan commitment, then banks will have credit risk. So businesses could affect by loss of key customers, their mismanagement, liquidity if they get into lawsuits, disputes, frauds, or any other strategic default, and as a result, businesses will collapse, and the money what you are given to those businesses as credit facilities, you may not get it, and then you will have a credit risk. So I have divided individual and businesses into this and shown you what could what are the factors which will create non-payment, and when non-payment occurs, we have credit risk. There are more reasons you can give for non-payment facilities. When non-payment facilities, what happens? When customer doesn't pay, in your balance sheet, the current assets, part of those current assets in the loans and advances that need to be categorized as NPL or non-performing loans, or NPA, we call it non-performing assets. More reasons here we have given: inefficiency or poor governance of credit culture. This on the bank side. If you are very lenient in our credit policy and due to non-credit worthy customers as results, if you have a non-performing assets, we call it poor governance and credit culture. Also will create excessive credit concentration. If bank thinks the subject, the item where we could make money is tourism, and if we had concentrated on that, now we will face the music because that particular industry is in trouble. Excessive credit concentration always one time. During boom time we will make money, but when that industry gets affected, we will lose a lot of money. Heavy related collateral. If you only think we have a security, we should not worry about it and give facility without looking at the customer's cash flow, we are actually still we will run into credit risk. Because of the collateral, customer will delay payments, and when we have security, we can't take action also. We will delay, and I told you credit risk will occur non-receipt of capital, interest, and not payment in time. So heavy relate or dependency on collateral, we might result in this area. More liberalized credit practices. Sometimes you give unrealistic values. Customer demands 100 million per facility, you may need giving a loan distribution, allowing him to take what he wants from the bank, then might run into problems. Pro-cyclical credit policy. Sometimes banks have adapt this. When there's sufficient liquidity in the bank, there's enough money in the bank, the customers have placed a lot of confidence, you will place a lot of deposits. You need to park this money somewhere else. You can't put in treasury bills and bonds all the money. During that time, your policies sometimes can get changed. You will give a little more leniency toward granting credit, and you will allow other credit units in the bank certain higher limits. You must increase your loan portfolio by say 20%. Then you get into a liberal credit policy. and as a result, you give it to not only creditworthy clients, you might get into customers who are unable to pay also. Lending to low-income borrowers and risky borrowers, considerable lapses in security documentation. This I don't have to tell further. So now we go into, before I give a break, I will want to touch um, credit evaluation. Now we have done on the credit side, we went to customer coming, we said loan origination, and we initially identified before giving origination what could go wrong and the reasons for non-performing. Now, having understood all that, now we are in a position to do a proper credit evaluation. That is, this is where we identified whether the customer is creditworthy, and if you do a proper evaluation, you can avoid the credit risk. Now, to do this, all the customers what we entertain in our bank are not the same. We have retail customers, we have individuals who are employed or self-employed, have a personal account and coming for a facility. These guys generally doesn't come for very large facilities. They either come for the mortgage loan. Mortgage loan means a housing loan. They come for personal credit. That means they come for reasons of personal need. They will transfer salary or whatever and want some money in advance to buy a those credit cards, housing loans. Those are retail products. That means those customers doesn't ask for very big money. Easy to evaluate because you don't have to run through a lot of ratio analysis to get their previous balance sheet. You collect very simple documents to evaluate. Sometimes only the loan application you take. Based on that few attachments, then you could see whether they are credit. This particular method is called credit scoring. Now I'll give an example. Say if I want a credit card from your bank, now most of the banks are promoting particular product. So I come there and I say I want to take a credit card, and you will say if I'm employed, provide me your letter from my employer stating my salary and other commitments. Based on that, you will decide my credit limit. Not only based on that, sometimes you will ask various other questions in this particular form. You will definitely ask my name and address. When I give the address, you will have another attachment. You will see whether it is my permanent address or mailing address. Then you want to know whether I have my telephone connections are mobile. You want to take my mobile number, you want to take my office number, you want to take my residence number. Why all this? Because if I give only my mobile number, you may not assign the marks which you want to assign to me. If I give the 3 telephone numbers, you will give me full marks on this question if I give all 3. That means I am showing you my full proof of contactability. So when you can contact me, you can always reduce your credit risk. So where credit card is concerned, one of the important factors is the contactability. So if person can be contacted, he can be persuaded to pay his credit card bills. So to contact, you need, sometimes you will ask my email address, all that, apart from the normal address, that is to arrive at the contactability. Then going through, you will ask property. next question is you will ask whether it is mortgage or freehold. If I say mortgage, you may not give me the full marks. If I say it is in my name and it's my freehold property, no mortgages, then you give my full marks for that particular question. So similarly, you have, we'll say, you also can go into a question like, my personal question like, are you single, married, or divorced? Just imagine you put single instead of married. Will you get the full marks? Because bank will think if you are single, you have no other commitments on your income. If you are married, you have to run a family, you need to look into your children's education, then your commitments will get, enlarged. Then my marks on this particular question get lesser if you see that single and married, or sometimes even divorce could have a different marking system in your bank. So this credit scoring is, requests the customers certain information on a loan document itself, and based on the answers you give marks. And when you total up these marks, we'll say the total out of, say, you have 20 questions, each has 5 marks, and the marks what you allocated for all these 20 questions, total up, we'll say I have 65. If your threshold is 60, I have passed the test. And then you will say, okay, you are eligible to get a loan or a credit card. This method is called credit scoring. However, retail credit has some other evaluation method also. This credit scoring is a kind of a, mechanical concept, the evaluator can, assign marks in excess of what is actually should be given, or short of what he should be given. As a result, your final total will get affected, and your eligible to your credit scoring will get, differ. But those days, bankers follow another very traditional method called 5 C's of good credit. And they still thinks, traditional bank still thinks, when you are giving retail credit, apart from credit scoring, use the 5 C's of in evaluating the retail. Remember, I emphasize retail credit facility. I told you retail credit facilities are like housing loans, credit cards, personal loans, that nature. You cannot use this for a business facility. 5 C's of good credit, probably you know it. So I'll show you what it is. The 5 C's of good credit are, the first C is character. Now, I told you we have customers those who are unwilling to pay, or we call it willful defaulters. Willful defaulters are checked from the character. Now, trustworthy and integrity are 2 words which I use here to describe character. You can't ask the customer, is someone to bring a character certificate, qualify on this character. But what we do is, we can run a report, we can ask for his past bank statements to see how he has serviced his previous facilities, how he has maintained balances. Those will amount to some kind of trustworthiness or the integrity. Integrity is actually the trust what you have on the customer. So trustworthiness is what is important to give him a good character certificate, especially if he has come in for a banking facility. Second item is capacity. So I told you loans can go bad only looking at the collateral instead of cash flow. So capacity is his ability to pay, ability to repay. Repay comes from his cash flow. We'll say, take an individual customer. if he has an employment, it's a guaranteed salary on a monthly basis, you can easily say if he's leaving alone all the other commitments, if he has a surplus, we can always say he has the capacity to pay. Capital, here I mean is borrower's equity. Now on these circumstances, borrower doesn't contribute to his facility. Now say, if we go for a personal loan, we don't ask him to bring in money, qualify for a personal loan, then it is the character of that loan will be also, we don't ask him to, place a fixed deposit to collect a personal loan. But borrower's equity means now questions how it is freehold or mortgage. That means customer has some kind of asset which has values. So those assets will allow him, even if he unable to get proper income from his cash flows, he will be able to liquidate those assets, generate money to pay. That's what we mean by capital. Conditions means either it is purpose of the customer or the situation where he is in. Say if a customer requests a facility, nowadays if a customer comes and say, okay, I want to go abroad and I need 200,000, probably bank will say with all these restrictions, I don't think it's advisable for you to go. So those are type of conditions you put because based on the customer's purpose or the environment we operate. So we need to look into those also before looking at the customer facility. Finally, I come the important, but I have listed as the least important because if other four are met, you don't have to really go into ask for a collateral. If you have a doubt in any of those other things, character, capacity, capital, and conditions, I recommend that you need to have a collateral because if there is loose ends in the previous four, there is a chance of credit risk and the customer will default. So pledge of an asset is important if you have to think that there is riskiness in giving this facility. Now it is 10:30, so what I want is was to have a break. And now what we have done today important is we have done types of risk, and in that we identified credit risk is the largest balance sheet item in the bank. Therefore, it's very important for us to know credit risk. And then we also looked into the credit process, which is a very important area. We looked at credit management, that's the business side of it. We are now in the process of, in that business side, taking each item and giving more description. So we have come to retail credit analysis, and in that we say credit scoring you can do, or you can apply the 5 C's of good credit. Then we also mentioned that the other one is conservation risk. That's what so far we have learned. I think I am summarizing so you to get refreshed. We have done 10 slides and 10 very important slides so far. Today I am planning to finish another at least 15 slides. So then we have another 25 slides for our next day. So take a break. We'll meet in, we'll take a break now. It is 10:35 almost. We will meet at 11 o'clock. Any questions if you have, you can post me out before we go for tea. Then we'll continue. We looked at the retail credit evaluation. Now we are going to SME. Now SME is little different from what we are looking to retail. Retails are generally individual requirements. You know what SME stands for, small and medium scale enterprises. But over a period, this particular sector has evolved into a very large sector. Most of the banks now would like to concentrate on set up most of the clientele what they get are into this particular sector. So a lot of banks need to understand this particular sector very well in order to cater to their clientele. Those days, SME means small and medium enterprise. There's no in between classification there, but now they call it three categories they have identified, and central bank has given certain values also in these. The first category is microfinance. Microfinance, or they call it mass employed. Microfinance is about mother and father operation, or the family operation. That type of business are managed by the owners only. Majority underserved. Now you need to be understand this. Underserved means they are very much in the rural sector. There's no banking branch is present sometimes. Bank, if they want to access this type of clientele, they may have to use field officers to get there. It's kind of a Grameen concept. So they don't have any financial reports to show you. That is, loan origination is very difficult because they don't have much information. So what generally in microfinance, what you understand what they do is they group certain number of people who are in the same kind of business and identify their requirement and then cater for that, taking inter customer guarantees or whatever, because uh, they work together in a group. When you work in a group, when someone guarantees the other person, both will have to honor their commitments. So microfinance business is that. Banks may find it very difficult to cater to this sector because you need to employ people in this sector to go into the customers' homes or in rural areas to cater and understand their business, especially for repayments. Uh, it's very difficult unless you go and do a personal collection. So now this particular sector has been evolved because the olden day um, rural has now getting into a little bit urban, and so then evolve a classic SME. That means they are the real medium scale enterprises. Generally, they are in retail or trading business. Still, the owner manage. Sometimes about 3 years in operations because they first activity and then get into classical section of classic section of the SMEs. Usually served by a banks under retail banking or consumer banking. Here, what I meant is it is generally catered by a branch bank, not a corporate sector, corporate finance division of a head office. Um, so branch bank will understand their needs and then cater for them. Now, out of this also evolve another level of customers. They being a small medium scale, but they have started commercial operations. A guy who had about more than 5 years being a small enterprises would like to develop their business into a kind of a commercial activity, yet they don't operate like a corporate. So that sector also has evolved now, and central bank also says any customer whose annual turnover is less than 600 million and a customer who has not borrowed more than 35 million from a bank belongs to SME. So we have a lot of commercial institutions falling into this category, and they represent this commercial sector of the SME. So they are kind of large SMEs, usually more than 5 years in operation, multiple banking relationship. Now here, earlier when you only had enough money to go to one branch and do your transaction. Now when you are in commercial activity, you have diverse interest or different type of businesses. You would like to give one business to one bank, the other business to the other bank, because you get the opportunity to borrow from two institutions. And nowadays, if you take a township, at least 6 to 7 financial institutions are represented there. So customers have places to shop around. They have a choice. So whoever they think will fit into their criteria, they will switch banking accounts. Sometimes these customers who have been SME and we have developed them into that, once they reach commercial, sometimes you may not be able to keep them only with you, because uh, sometimes your kind of facility or the limits what you have imposed on him is not sufficient for him to further grow. So they look for multiple banking relationships. That way, business point of view, we don't want to lose a good customer. But on the risk management point of view, when he wants to develop into getting into various other fields where sometimes his capability is not that good, he may run into risk of losing some profits. So sometimes these new businesses are being given to new financial institutions which have come forward. So good bankers, sometimes who are risk managers, will even allow your clientele to have multiple banking relationships, keeping you with the core uh, sector where he operates, where cash cows what he has with you. Sometimes they will also allow, when he bring a new proposal, and this guy will say, okay, uh, this bank also asked me on this, so sometimes better to send him over there, because you have already got his securities and thing covered. Sometimes the new facilities you may have to borrow clean, and then risk will be passed on to your competitor. So banks do that also. And when they reach commercial level, you need to have very constant touch, otherwise they will go. So you need to actually follow that, not to lose your existing business. So high value emphasis on relationships. Sometimes you may need to appoint designated person to look into this type of clients, look into their requirements um, on a very more focused way, and help them speedily so that they can get their facilities and banking requirements quickly. So these are the three types of SMEs we have. Now we go into the evaluation. Now I put this slide because a lot of bankers who serve SMEs are complaining. It's very difficult to do a credit evaluation SME. Sometimes because financials are not there. Uh, you don't have a judgment of doing the management style. So I have put some of the difficulties here for us to ponder and discuss further. Uh, One is the financials versus management. Now say most of these guys, they sometimes prepare when they come to commercial area, they will use accountant and prepare financials. And very well, they might prepare two sets of financial documents. One is for the Indian revenue, other one is for the banks. Banks, they will always show profits, even more than what they make sometimes, in order to get facilities. All of them, so they will show lesser profit to avoid paying income tax. So you can't really evaluate using their finances. So sometimes you may need to use your judgment and skill to evaluate based on the information what he has given. So sometimes we may have to construct their own financials. So it's very important to see how they manage things at their own level. Uh, so management of their businesses also very important. So you need to evaluate customer of SME. You need to have very close personal touch. Meet him on a regular basis in his business premises. See how he does things. Now, for instance, I'll take example. You go to a, you say, retail shop. You looking around, you can see it's a well-stocked business. Then he has given you some statements to you, some statements for the inland revenue. Sometimes he may give you even the statements what you have given to inland revenue with lower profit. So with that you may not be able to give his requirement. So best thing is for you to judge and see whether you could construct kind of a rough finance for you to understand the finances what you are given. Now you can ask few questions to build up this uh, information. Uh, Generally, the bank when he go to retail shop, he will meet the owner, greet him, and then you ask how is your business today, and then some people will say do well, some people say these days we have little slack in the area. So then you will get into a conversation, and then you will ask. උදාහරණ දවසකට කොච්චර business තියෙනවද? Then he will really reveal a figure, He will tell a daily sales amount. He will tell the average daily sales amount. He will say දවසකට 50,000ක් තියෙනවා. So you know that his daily sales will be 50,000. You can casually ask how many days you are open for a month. So if he says they are open for 25 days, monthly sales figure will be 25 into 50,000. So you have created his sales figure immediately in your mind and you note down. And then you verify with his financials. Financials are for a year. That you can see a difference. Then you know whether either he's giving a percentage of his sales or he's giving multiple of his sales. So based on that, you can adjust the rest of the finances from based on what he has given. So these sort of tactics the bankers do to evaluate customers' finances. Then other criteria we looked into is repayment versus collateral. Now all these SME guys, sometimes they think banks are reluctant to view them. They will come and immediately say, "Mama mage ගේ උගස් යන මහත්තයා මට ලක්ෂ 10ක් දෙන්න." That kind of uh, uh, request will come. So he is actually giving you a security, then other information for you to evaluate. So bank should not get eager on the security what he is provided. He should be able to see whether he has a repayment capacity. Having a collateral is good, but having to realize a collateral if it's a non-payment is not very easy. Especially if he's giving his residential property, you may not be able to throw him out. And legal process take very long period, and all this during this legal process you run the risk of credit because court will not allow you to charge interest on those periods, and they might even not allow the interest rate what you have charged. They might quote a different rate. So either you lose interest or capital, and then time value of money because he's not going to pay you immediately. All that will lead to credit risk. So repayment is important, more than important to collateral. So finances are more important than his management. He will come and say, I have this, I have that, but I do this. But you need to construct some kind of finance for you to evaluate his strength. Then past record versus future prospects. Sometimes we go by past records. Past records are very important because if he has service a facility right on time, we consider him as a good customer. If he has defaulted in the past, we looked at him like, he's not a creditworthy guy. But we also need to look at his future prospects. So future prospects means whether he has entered into a new kind of contract, um, whether he has now acquired new capabilities and a new partner has joined him. That kind of thing also you need to consider. Important. Company versus industry. Now this particular customer of yours has a entity. It can be a company, partnership, or a proprietorship, um, dealing in type of things pertaining to industry. Now we'll say you have a customer, we'll say he's a manufacturer um, of brassware, we'll say. Now brassware manufacturer, this particular industry has a lot of competition because Sri Lankan brassware, they need a lot of labor, cost is very high. We don't have the sophisticated machines like the imported brassware what we get from India and all that. So they send, you can get lesser priced imported stuff for this particular industry. So the guy who is in this particular industry now find it difficult to have that. So industry is in trouble. However, if he has established, if customer base what he has for his production and he's selling fast and he can beat the competition of imported stuff, we say his company is doing well or his business is doing well. If he is in that position, we must not really worried about the industry. He has established a market for himself. He has adequate sales. His, even though his cost is high, he can price his stuff high. Quality is somewhat maybe better than his imported ones. So he has established. So you need to look at those areas before evaluation of SME credit. So it's very important you looked into these 4 categories of what I have put. You need to construct his financials. Management is important, but sometimes he say, I have this, I have that, all that is not sufficient for you to, consider facility. His repayment is important. How much money is going to generate. His cash flows more important than collateral he provides. Collateral also important, but we need to have both. Past record versus future prospects. Past records can be very good, but if he had his business in the tourism industry, which has a lot of guests, he has taken all the money from the bank and repaid. But look at the future prospects. In the current situation, then his future prospects are very limited and he may not make money. So you need to look at all those company versus industry. So mainly SME credit is done through the experience of a credit analysis, and sometimes his or her gut feelings are very important because lot of SMEs in this country has gone into become very commercial entities based on the way how managers have handled it, and this is the area actually in Sri Lanka more than everyone wants to start their own company. So they will start with micro level, then move on to classic SME, then move into commercial SMEs, and still manage things of their own. And you can see every township has so many businesses, variety of businesses, and all of them are not big corporate giants. Their borrowings are less than 35 million. the annual turnover are less than 600 million. So they fall into SME categories. Yet they contribute hugely to the economy, and that's the area bankers can focus, because not like corporate lending, you may able to charge more from this sector. So your interest margins are very good. Um, if you analyze properly and use your experience and gut feelings on these clients, you can get their repayments with proper personal relationship. So higher income and very large sector to market things. This is a very good area to get into, but you need to pay your attention to financial versus management, repayment and collateral, master orders and future prospects, the company and the industry and all that. And use your experience to grant facilities to this sector, and you will avoid credit risk to a great extent based on your experience. Now we go to the third sector of evaluation, which we go into corporate credit. This is a tricky area, because these guys actually we lend not to the company. Previously, you lend to the individual on a retail basis. Even if you lend to proprietorship or partnership, those is different because board of directors. They may not be the owners. They also can contribute shares, but sometimes the shareholders are different from the board of directors. Board of directors manage the company business through business line CEOs and various other positions in the business, but owners may be different. So, and one good thing in corporate is their financials you can rely on. That means the information what you collect from a corporate, their financial documents what you collect from them, will be audited. So you collect audited financials. So third eye has been looked into their documents what they provide to the bank, and you assume those are in order. You can do various other checks, but to a great extent, audited financials will represent the true picture of a company. So based on balance sheet, you can have your lending approach. Now in corporate customers, I told you, anyone who is less than 600 turnover, less than 35 million borrowing will fall into SME. Now anything above that is a corporate client. And generally they require large facilities, and therefore bankers follow different models of evaluating them. I proposed and I generally practice this. We looked into the purpose, we looked into payback is repayment, we looked into the risk of the business, and then we looked into the how we could structure facilities. Structure means how we could, because these corporate clients will not take just one loan. They will come for import loans, they will ask for export loans. What I mean is trade finances, they ask for leases. You need to structure them based on their repayment capacity or the cash flows to recover the money. So structuring is very important to reduce the risk. Now I move on to, we'll look into these items one by one. The purpose. What do you think the corporate wants money for? Most of the corporates require working capital is actually in financial terms. For your balance sheet, if you look at how to see what is working capital is, you take your current assets, you reduce the current liabilities, then the answer what you get is the requirement for your working capital. So that you need to borrow money by way of either overdraft or a short-term loan or whatever. So that's one of the purposes. Generally, corporates require money from a bank. I would say corporates also require money for purchase of fixed assets, because not like banks, corporates sometimes they're in manufacturing industry or trading activities. They require large number of buildings, then plant and machinery, vehicle fleets, all that need, not just working capital, they need kind of a long-term borrowing. So we call them asset financing. So corporate can request from a bank to finance the asset. They can ask to, lease a lorry. They can ask for a commercial loan to purchase a building. They can ask for a long-term loan to, buy a machinery or plant. So these are called asset financing. So we have looked at two kind of purposes: working capital, asset financing. Asset financing also you need to, the last one what I said is plant or machinery. Different type of evaluation you need. Now you see the purpose of financing the plant and machinery, you can use different methods. Internal rate of return. You can see how much money is going to generate over a period during the lifetime of this machine, and whether those money what is being repaid can be achieved based on this income coming out of this machine. So we use various project related evaluation methods to find such things. So fixed assets and other financing require that kind of project analysis kind of a method to evaluate. Now I'll give you another example. Company will come and say, to pay a debt which I owe to another bank. Now that kind of a request will come from a corporate client. He will say, I have facilities from bank A, which is you. I also have bank B and C, but C is charging me little high interest, which I want to consolidate those facilities with you, and I need a loan to settle that facility. So this is his request. Now, as normal bankers, as human beings, we think, why should we pay to another bank to acquire their facility just because customer wanted? But as I told you, we rely on the customer's balance sheet of his lending facility. Now, if we either borrow from A, B or C, his balance sheet is not going to change. If we transfer 500 million from his borrowing bank C to borrowing bank A, which is you, his balance sheet is not going to change. If you had earlier given 500 million to him, another 500 million, you will have a 1 million facility to this client and no facilities to C. But his borrowing from the banks in the balance sheet, his liabilities will remain same. So if you have relied on the balance sheet of the bank, that your customer to decide this loan facility, I don't see any reason why we should allow that kind of request and take over that facility. So this kind of request also could come from corporates. You need to be ready. So purposes may be vary depending on the customer's requirement. Payback. Payback is repayment. We always say cash flow profit is the method where customer will judge his repayment. So you will drop corporate client, you will ask for his income expenditure statement or profit and loss statement. In that you will see that he has made profits, and based on those profits whether he can pay back. Then we also looked at his cash flow statement to see those profits are not just book profits, but which has come to his balance sheet by way of cash. If it has come by way of cash, he is in a position to repay. So cash flow most of them repay. So you need to have those two statements. You need to have customer's income expenditure statement. You need to have customer's cash flow statement to determine whether his repayment capacity is there. That is also not enough. Sometimes your customers give credit, and when you give credit, they create debtors, and these debtors will appear in their balance sheet. Now, you think all those debtors are going to pay to this customer, then he will get cash. But unfortunately, like customers default to us in their credit facilities, your customer's customer, that means your customer's customer also may default your customer. And when they default, they have to write off what is in their balance sheet, which is an asset. The debtors list is an asset in your customer's balance sheet. And that asset will become non-performing. When customer has non-performing asset, he is giving the wrong picture to you, saying that he has so much of assets. So for that reason, you may need to ask, what is your credit policy? Customer say, we give maximum 60 days credit. Then you ask age analysis of his debtors. Anyone who has, if he has debtors over 60 days, that means those guys are not paying, or they are delaying payment, may result in loss to your customer. So you have to disregard in your consideration all those bad debts. Similarly, customer's asset statement has stocks. The stocks will represent the value of things what he has. But some of the stocks which cannot be marketed or cannot be sold. When he has items either obsolete or cannot be sold, those values are not representing the real value. Those may be able to sell for at a very low value, or sometimes he may not be able to sell at all. So you need to deduct those items from his balance sheet when you are deciding payment. So payback can be always cash flow statement, provided this balance sheet's been adjusted to real debtors, real stock, without having bad debts and obsolete stock. Then customers repayment, sometimes customer will come and say to you, I will liquidate my assets and pay you. That is my repayment arrangement. What do you think? Assets, you always customers will get bankrupt. In corporate clients, it is not that. Customer can acquire assets which can generate income. Customer also may show some assets in this book, the balance sheet, which are not generating income. For example, I'll take, we have a customer who has a factory in a 1 acre property. Actually, factory is generating money and it is only occupying, we say, 20%. So his rest of 140 purchases in that particular land is just there. Sometimes he may take a lot of, he will use some money to clean those and not generate income. So if this customer says, I am going to pay by liquidating some of my assets, probably he might sell part of that property to sell. So he may be asking facility until he find a good buyer for that. So those things also sometimes valid repayment or valid payback method. So we need to look at it. We'll take, for example, property developers. We'll take example, guy who make condominiums for resale. So his assets include those apartments. Those will be aware in his balance sheet. So when he sell them off, we are taking that item from his balance sheet. Similarly, customer stocks which are in the current, but you can have it in your fixed assets also, certain items which are not generating income, but the company's idea is to sell at a later date, and until such time, sometimes they ask for facilities. So you go into like what we discussed, the purpose can be for settlement or debts elsewhere. Payback also can be, repayment through asset liquidation. Now, I want to look at the risks. Now, risk is very important because, like, we face risk like reputational risk, financial risk, operational risk, regulatory risk, uh, strategic risk, legal risk, technology risk. All these risks your customers will also face. They might even face more risk than banks because banks have proper risk management unit. Sometimes your customers may not have that kind of risk management capability, so they will be more vulnerable while doing business because they are the guys who take your money. So, risk of the case need to be identified by the bank before you lend money. So that's very important. That's why in our corporate credit model, we looked at the purpose, we looked at the payback, we looked at the risk what the customers encounter. And if those risks are high, we should not part away with our money. If those risks can be compensated by some kind of collateral, then it's okay. Because collateral is a risk mitigation factor. But we need to understand those risks well. So we'll go into this particular fund, the risks that jeopardize repayment. So these are the risks what the customer faces. Like us, they also face financial risk. They also face some kind of, they call it business risk. They also have risk of management and ownership. They also have risk in macro condition. Macro condition is the environment they operate. So we are going to discuss this little more for you to understand the counterparty risk, because this customer is going to face those risks. And if those risks are major, you should not part with your money. That's what our aim is. So we look at financial risk first. Now, to arrive at the financial, I told you in your evaluation, we say we evaluate financial risk and the qualitative risk. Now, the financial risk is about customers' liquidity, his solvency, his ability to get money, funding strategies, what kind of instrument he can use to get money, how does he operate, the efficiency of the company, whether he is making enough money at least to pay the interest. We call it interest cover. When we look at profitability, you need profits to pay back. We told you repayment comes, we give first priority to cash flow profits. So very important analysis of financial risk is to make sure whether customer is making money. So profitability is very important. Whether he has enough liquidity. Liquid means he has able to, he has not blocked his money in capital assets which cannot be converted to cash, so he is unable to pay. So we need his liquidity also. He wants to have his cash flow. We need solvency. That means he cannot he also contribute some money, so that if anything happens, he also will feel the pain to get his business going. So financial risk measures the stability of the company, flexibility. Variety means he is diverse enough. Cost of funding, whether he is not borrowed very heavily at very high rates, rate of interest, and what kind of collateral account we need. So we are going to look at some financial risk factors to ratio analysis. Sometimes you may have done this. So therefore I'm going a little fast on this because I can see your credit management um, syllabus has financial ratio analysis as a separate module. You will learn. If you are not done, you will learn it much more in details. But I want you to understand a little bit of it, where the financial risk arising from out of these analysis is important. So we looked at first liquidity. Now, liquidity means you need to understand, liquidity means company's ability to convert current assets into cash to meet current liabilities as and when fall due. Now, you need to understand this definition. Either you must have cash to pay your liabilities, or you must have current assets, debtors which can be realized in short period. Stocks can be sold in short period, or some investments in other areas which you can realize immediately to meet current liability. So it's very important to see whether you have sufficient liquidity to run this company, because otherwise what happens is you will get into other areas of risk. Now we'll say you have provided say 10 million worth of goods to this particular company. This particular company is the bank's customer. So he has to pay this money to his supplier within, we'll say, 2 weeks. Now his overdraft, what we have given is 10 million. Now it's already 6 million overdrawn. So he has only cash 4 million. Now within 10 days, you will get a check. Whereas the balance is 4 million. Now that's where the liquidity is very important. So during the next week, he must pay in cash to the value of 6 million to make 10 million available balance to meet that check. These are very common occurrence in the bank, and otherwise, on the due date, he will be running into bank. So please honor this check. In the evening, I will somehow bring the money. And sometimes, if he has failed, knowing very well he has 10 days to pay. If he has failed last 10 days, just imagine how he's going to create money by evening. So you know the risk. So that's why liquidity is very important. So liquidity is calculated current assets or current liability. That means we see a percentage of current assets compared to current liabilities. We say if a customer has 100 million current assets and he has liabilities of 50 million. So 100 divided by 50 will give, result is you get 2 current assets to 1 current liability, 2:1. So generally bankers are very happy if at least his current assets has double the value of current liabilities. What it denotes is sufficient current assets to meet current liabilities. So in this ratio analysis, what we are looking at is current assets are more always than the current liabilities, sometimes double. Bankers, especially if you are in trading activity, your customer, bankers demand you must maintain the current ratio of 2:1, because if you start buying on credit and stopping it, and if you are unable to pay them, then you will run into a problem. And bankers will also have credit risk based on that. That is current ratio. Now, but I have a corporate client, which I evaluated some time back. He's one of the largest corporate. So sometimes LND magazine, one year they said the largest corporate of Sri Lanka, his name came. This particular company's name came. And they are still very large. A very large stores they have, but most of the stores, the items what they are in their stores is doesn't represent to the value of current liabilities, because their current liabilities very much higher than what was available in the stores. Simple reason is that they always take goods for resale for a 90-day credit period. When you say if a customer take a 90-day credit period, at least this particular customer will take 90 days to pay his supplier. During these 90 days, he will sell 3 times of supplies what his supplier has done to them. Now say, for example, I want to keep an item in the supermarket, and supermarket say you can, at one shipment, you can bring 100 of your product and display it, but we'll give you after 90 days. I go to the supermarket after 2 weeks, I see all the things have been moved, been sold. Then the supermarket guys, huh, uh-huh, huh, uh-huh. All right. Mama, oh, hmm. මම විනාඩි 10ක් කරගෙන කරන්නද තා? Right. Okay. So this particular company has, when I looked into their balance sheet, current assets in their compared to current liabilities only 0.38, not even 1, because they don't pay their liabilities in less than 90 days and get 3 or 4 times of their stocks which have been sold. So it is not available in the stores also. And they have made cash. And that cash has been invested elsewhere. And it is, they don't just keep cash in their current assets. They have used that cash to, make fixed assets. So lower than liability. But they can afford to keep lower current assets and still make a lot of money doing that. So you need to identify the business model of a client also, without blindly saying that always current assets must have higher value than current liability. So this also need to be identified. Now I give another example. We'll take a company like Dialog. Dialog, how they do operations? They issue prepaid and postpaid. They prefer prepaid because you pay the money to them by taking those cards and available their services. They have not provided you the services, but they have got the cash. And that cash they are not going to keep as current assets. That cash they will invest in long-term assets, or they will invest elsewhere, not showing under current assets. But they owe you that under current liability to provide the service. So in your balance sheet, current liabilities are high. based on the number of cards sold. And the cash what they have got is not available in the current assets range and show lesser value. But company is running well. Their liquidity is so good, they don't have to pay you, only they have to provide you a service. If they want cash, they can liquidate some of their investment and pay you. So this type of business models also there. We call them, their current assets have been financed by suppliers credit. And if you have a business model of that, it's one of the very good business model because you don't have to borrow money to finance your current assets. And when you have that situation, and it's very profitable because you don't have interest uh, expense. Then we have quick ratio. Quick ratio is you remove the inventory or the stocks out of your current assets. So it will represent only the cash and debtors. You divide by current liabilities and you see the value. In a trading company, if you have current ratio 1 to 1, that means current assets less in stocks is 1, current liabilities also 1. We still says quick ratio focuses on more liquid assets. That means you have enough liquid assets to pay your customers. So 1:1 is even good enough. So this is what the liquidity means. I am going to solvency. Solvency is whether your company is a bankrupt company or a running company. And a going into which non-equity capital is used to finance assets of the company. So we want to see how much of borrowed money from banks are being used to finance the assets without customer contribution. So what we do is our denominator, or you divide always by shareholders equity. Those days what we looked at is long-term debt. That means all the loans which have been taken for repayment over 1 year is listed on top, and we divide that amount by shareholders equity. So if your long-term debt, we'll say you have borrowed 75 million from a bank to do a project, and we'll say you have, company has contributed 25 million into the equity. So in that case is 3:1, 75 to 25 is 3:1. Generally all our project financing, we looked at the gearing and see at least customer must bring in 25%. So we are happy that to give 75%. But unfortunately, now customers getting into very large short-term arrangements. So if you take only the long term, we might not get the correct picture of customers' gearing. So best thing also to look at long-term gearing, we also must look at is current and long-term gearing. That means all the borrowings from the banks, whether it is short or long, and we divide that by shareholders equity to arrive at kind of a very, very hardening or stringent solvency method to arrive at whether it is a going concern. This is important because if he has only living on debt without customers' contribution, there are chance of huge credit risk to the bank. So that's why we insist customers to make contribution. For today, I am going to touch only on this particular slide, which is the 18th slide. We can catch up next time, and which is the profitability, which is, I told you cash flow profits are very important to run the business, and we looked at two kinds of profitability. One is how profitable are your sales. That means what are income. We looked at, if you see a customer's profit and loss account, the most top item is your revenue, or we call it sales. Then what you do is you deduct your cost of sales, amount of money what you invested to sell those items, you deduct from there and you get your gross profit. So if you deduct your gross profit by sales, no, if you divide your gross profit by sales, you get the gross profit margin. Now we'll say, for example, we have a customer in the pharmaceutical industry. We import pharmaceuticals and sell in the local market. So his cost involved cost of the goods, bringing it to Sri Lanka, customs, and all clearing charges are all his cost of goods sold. So we'll say he brings 100 million worth of goods for resale, so he sells 100 million worth of sales during a year, and it cost him 65 million. Then he has a 35 million gross profit. So 35 divided by 100 is his gross profit margin. We say 35% gross profit he has. Then after his gross profit, we have to deduct various other things to arrive at the net profit. The first thing is his administrative expenses. That means sales and administrative expenses. When you deduct that, we get an item called, we deduct that, and also its depreciation, we will get operating profits. We call it earnings before interest and tax. Now, operating profits also can be divided by sales to arrive at what will be his operating profits. So, these are cost concern of the bank, of the customer who wants to, segregate and see where his costs are going to be. So, if you want to see his profits, net profits, you deduct his interest payment, you deduct his taxes, then you arrive at the net profit. You deduct net profit by sales, you get net profit. Your gross profit can be 35%, but if you deduct all the other expense items, your net profit can be about 5%. How profitable is your sales? If anyone having a negative net profit, that means items what he sell is not generating income. Then banks can easily say, look, you are not making money. Why should we put our good money after your bad money? So we can decline those facilities. So any customer who wants to borrow money must show a net profit margin to convince the banker to invest in his company. How profitable is your company? Now, company, I told you that profitability is about his sales, which is from his income and expenditure statement. But that doesn't give whether the company is profitable. His items what he sells are profitable. To make your company profitable, we have another area of look into. We call it return on assets. In your balance sheet of your customer, you have current assets, you have fixed assets, and that works to total assets. Now we deduct net profit from your total assets to arrive at return on assets. So you must have a positive figure. That means your total assets must contribute to make money for the company. Now say if your total assets are 100 million and you are making 150 million, so 150 million divided by 100 million is your value. So you are making huge money. But if you say you are making 5 million and your total assets are 100 million, you make 5% return on assets. Sometimes 5% return on assets are good enough because you may have 7% net profit margin, that is from sales, but your return on assets are 5%. That means 2% of your assets other than sales are not generating, but those are required to run your company, like plant and machinery, excess land what you have. Those also needed to run your company. So you can have this for net profit before interest also divided by total assets, but return on assets means net profit divided by total assets. Then we also need to know your shareholders equity. That means how much customer is making. Money to return on assets. Return on, that's what the company shareholders have contributed. So your net profit divided by shareholders equity give return on equity. If return on equity is less than money what they can earn from fixed deposits in the bank, then the shareholders will think twice. Why should I take risk in investing in this company? I can place my investment in the bank and make more money. So you have to make sure that current interest rates, we will say 5% on fixed deposit, your return on equity of your particular company which you are analyzing must give more than 5% to the shareholders for them to have investor confidence. So today we looked at 3 areas. That is, we looked at the profitability, we looked at the solvency, and we looked at the liquidity of a company in our financial risk analysis of your company. And with that, we have done part of corporate analysis of the customer. And today we are going to wind up here because I don't want to overload heavily on this to you, for you also to go and do some learning out of this. And then we'll meet. Once again, I need to mention that next Sunday we are not meeting. I'll be available only not on 16th, but only 23rd Sunday for this particular presentation to complete risk management, credit risk management on module on your credit management diploma. So if you have any questions so far, you can raise now. If you have any questions, you can unmute your microphone and ask me before we stop the presentation. If I don't get questions, I think you all understood everything, and then I'll be a very happy person. So far,